if you go to the developed world, in the aftermath of the last global financial crisis, there have been several regulations, especially in the UK and the US, around bonus schemes to ensure that people, because of the drive to perform, to drive performance, which invariably is actually not tied, is tied more to individual grit rather than the long-term or sustainable profitability and growth of the institution. So there have been several regulations around how to do bonuses, new things like clawback provisions. So if I pay you bonus on the back of the performance you achieved in 2017, for example, how do I ensure that in achieving that 2017 performance, you've not packed what I call crappy assets onto your balance sheet? So part of what people are doing now is, okay, I'm supposed to pay you 10 naira for what you have achieved, so I pay you 5 naira, and I hold on to the balance over some period of time, because don't forget that until your loan book becomes seasoned, you don't actually see, and loans typically you don't begin to see. NPL is a lagging indicator. So most of the time, you need to wait 24 months, 36 months before you begin to see the impact of decisions that have been taken today. So as part of this tension between risk management, as risk managers, as risk directors, we should take interest in the way the incentive schemes are designed. If not, you will be continuously be at friction with your colleagues, rather than proactively getting involved in a single conversation, which is around what should be the right KPI. Is at the point of people trying to book and put transactions. And I think this is probably where the regulators can also play a role in terms of encouraging and begin to have a view around how should executive incentive schemes be structured in the market, so that, again, we've gone through this bout of boom and bust in the sector. How do we begin to ensure that we have some, at least relatively longer term stability? So for me, that's another very important thing that we need to deal with in practical terms when we are talking of risk management and how to embed the right code. The other pillar I want to touch on is about what is that, the alignment between the business strategy and the risk strategy or the risk management. In most institutions up to today, risk is actually seen more as a compliance function. So the regulator said our single obligor limit should be X. I will set my single obligor limit at that, without any bearing to what your risk appetite is, what your risk capacity is. And actually, if you look at a very big institution like a First Bank, because of the size of the institution, our single obligor limit is about 100 billion naira. So really, if you step back, how many institutions should you actually be willing to advance that level of credit exposure to? And that's why risk management needs to move, and a number of metrics that even the central bank has prescribed for all. Smart risk directors and risk managers, they need to step back, evaluate those thresholds within the confines of their own business, and say, how will I apply this? So, for example, in First Bank, we have this concept, which again was part of what we've done as part of the rejigging of our risk framework. We have what we call the operating obligor limit, which is a fraction of the single obligor limit. But the single obligor limit is to comply with regulation. But you're saying, you, as a CEO, what are you comfortable with to advance to an individual, a company, or a group of related companies that you will not be having sleepless nights? So we have this principle of operating obligor limit, which for us is 1/3. Because we're a very massive bank, is 1/3 of our single obligor limit. In crafting that, our new policy around this, for example, we've told our board in the ordinary course of our business, we would not do transaction above the operating obligor limit. However, in exceptional circumstances, we can or we will go beyond that, but we as management will come back to you with board to justify to you why we should take 100 billion naira exposure on a company or a single. And honestly, to be our chief risk officer here, in the last 2 years, that has helped us to manage things much, much better. We are dealing with massive exposures of the past, but today, because that is actually an integral part of our risk appetite definition, we've successfully tamed our, what I call unbridled risk appetite. But to take this forward, the way this should work, and again, this is where, as risk directors, risk managers, our role in strategic planning. When we've defined what the corporate strategy will be or what the business strategy will be, is there an alignment? Have you gone back to your own directory to say, in response to this corporate strategy, what should be the risk strategy that is aligned to that corporate strategy that ensures that, and in crafting your risk strategy, it could actually throw up whether or not the corporate strategy itself makes sense, actually. So I give you a very good example. So you are either the CRO or the CFO, and you look at your capital headroom, and your capital headroom possibly cannot take more than, let's say, additional 300 billion of risk assets, additional risk assets. But your corporate strategy is suggesting that you want to do 500 billion of that. So clearly, there's a misalignment. So part of what I always advocate is in crafting the corporate strategy, part of the sub-strategy that needed to be crafted and must be fully aligned is the risk strategy, ensuring there is proper alignment. There's no need in promising A, B, C, D under the corporate strategy, but in reality, you don't have the capital, or you'll be putting the institution at risk. Because truly speaking, you can do any risk, you can book any credit you want, but in reality, you are putting the institution at risk. And it's not just, when I talk about risk strategy, I've used credit extensively because that is what is much more discussed there. It's also very important, you also need to look at even your market risk. Because a number of us today, we are running big treasury. If you see the financial of a number of banks, people are beginning to make significant sum of money around swaps, around other financial instruments that the primary risk, they are not necessarily credit. But have you dimensioned those risks? If rates moved, I have a story to tell. In 2009, there was an entity that, because rate, prior to 2008 or 2009, if you recall, Naira-dollar exchange rate had been relatively very stable. So they chose to run a very large open Naira position. The day central bank devalued, they lost about 40 billion Naira. Because what they've done basically is that they've gone to the international market, borrowed dollars, which was what most of the foreign portfolio investors were doing then. Converted to Naira, you borrow at 6 Naira, at 6%. You are lending, if you remember, rates then, that was when we were trying to get the sovereign yield curve. So I think at that time, you recall, some instruments were even issued at 18, 19, 20%. So it was a no-brainer. You borrowed at 6, you are lending at 6, rate is relatively stable, so it was. But suddenly, central bank came, devalued overnight, and they lost so much money. So the point I'm trying to make is that in crafting your risk strategy, it's not just around credit, it's also to look at the gamut of risk that the new corporate strategy is likely to introduce to your business, and ensuring that your risk capacity and your risk appetite have been properly defined in that respect. Indeed, my own view really is when you craft your business strategy, the question to ask is that what are the risks embedded in this strategy? What are the old risks that will probably become amplified or some will become diminished. But more importantly, what are the new risks that is crawling into the business? Very good example. Over the last 2-3 years, a number of us in the Nigerian banking space, we ventured heavily into e-payment, digital banking, etc. How have we dimensioned the operational risk inherent in that space? So that's a classical example of a risk that was probably very low some 4 or 5 years ago, but today, given that we've all migrated, or we're all migrating in that direction. A bank like First Bank, 82% of our customer-initiated transactions are initiated outside of our branches. So it's through cards, it's through our various digital platforms. So really, our risk suddenly has migrated from people trying to steal whether 10 million or 5 million from all the branches to online risk, people trying to attack your system and trying to take money out. 2 good examples will jump out here. In 2015, I'm sure the director will know this, or 2016, a Nigerian bank suffered a cyber attack. The attempted sum was $120 million.